There are big weeks in real estate, and then there's what we saw this week in real estate. We saw major movements in the landscape that are going to really move the needle when it comes to Vancouver housing. Inflation hit 2%. The feds in the states cut interest rates for the first time in 4 years. CMHC changed the insurance mortgage cap for the first time in 12 years. Housing starts, well, they are absolutely falling off of a cliff. We have updated arrears data. Developers now are pushing back on these egregious city fees. Debt service ratios in Canada hit a new all-time high, and the Vancouver real estate fall market looks to be, well, a total dud. There is an immense amount of things going on in real estate this week. Let's dive right into it. I think the first thing we want to discuss today is inflation, because inflation officially hit the Bank of Canada's target of 2% this week. It actually beat it. It came in at 1.95. So we're below the target range for the first time in nearly 4 years. If you go and pull out the good old mortgage interest component of inflation, well, the total print would have just been 0.9% last month. Rental inflation, though, that's still showing a high reading, and it's actually showing an increase right now. It came in at 8.6%, although you can definitely expect that to drop off quickly as rents realistically have been falling nationally for about a year now. So obviously they're referencing lagging data, and when that data catches up, well, you can expect inflation to push even lower. Markets are now pricing in further rate cuts. They are pricing in a rate cut at every single Bank of Canada meeting from now until at least summer of 2025. There's 7 meetings between now and then, for your information. So that would equal 175 basis points in cuts between now and July of 2025 on the low end. That would ultimately put the overnight rate at 2.5%. 2.5% is where we may be sitting in a year from now based on today's economic forecast. And the all-important Canada 5-year bond has continued its path downward on this news. As of today, it's sitting around 2.7%, and that is the lowest in over 2 years.
Pretty interesting to hear that inflation, if you remove the mortgage interest component, that we're sitting below 1%, because that produces an entirely different set of problems as well. It may not just be, it's good news that inflation's coming down, but if it goes too low, then we have a different problem. Anyways, we'll see where it goes from here. But let's look at the Fed rate cut, because today or yesterday was a big day in the US. On Wednesday, the Federal Reserve made a notable move by reducing its benchmark interest rate by half a percentage point. This is a significant change after more than 2 years of high rates. In fact, I think most markets were pricing in a 0.25% cut, so an oversized rate cut is quite interesting and somewhat telling. These higher rates have been effective, there's no doubt, in controlling inflation, but have also led to more costly borrowing costs for consumers and businesses in the US and largely abroad, any economy that's also attached to the US. The rate reduction, the Fed's first in over 4 years, signals a shift in its priority towards supporting the labor market, which has shown increasing signs of slowing down. What's also interesting is with the presidential election approaching, this adjustment will certainly have the influence, certainly have the potential to influence the economic landscape and those making votes around certain candidates. What's more, too, is the central bank's decision lowered the key rate to 4.8%, down from 5.3%, a level it had maintained for 14 months to combat that high inflation, the highest we've seen in 4 decades. The last rate cutting cycle, started in June of 2019. I went back and had a look at this, and it also happened to coincide with the presidential run-up when Biden was elected. We back up even further, and the Fed fund rate sat at 0.25% from 2009 all the way until 2016. And rates haven't been this high since 2001. Fast forward to today, and inflation has since dropped significantly from a peak of 9.1% in mid-2022 to 2.5% in August, which is as close to the Fed's 2% target as they could probably get today. Policymakers have also indicated plans for an additional half-point cut in their final two meetings of the year, November and December. They anticipate further rate cuts in the coming years, with 4 projected in 2025 and 2 more in 2026. Jerome Powell stated that the U.S. economy is in a good place, and he added, "Our decision today is designed to keep it there." This will have the added effect of boosting the stock market up, though not by a huge amount, as the expectation was largely telegraphed to the marketplace prior to this happening. With that said, this morning, the Dow Jones was up 500 points as the market continues to react to the news, though we haven't seen markets necessarily rip on this news. And again, like I mentioned, that was largely because it was telegraphed to the marketplace prior to. Though in the coming days, there will be knock-on effects to this rate cut, and we could see that ripple through other markets. What's more is the other piece of this pie will be the unemployment or jobless rate that we will get later today. This will further impact the decision to cut rates in the US and the economies, again, that are attached to the US. This move will largely be welcomed by everyone, but specifically smaller capped companies who rely more on borrowing, business loans, and lower interest rates in order to survive and also to be competitive. Though I do have one sort of red flag with respect to this. It's a big move right off the hop. And while I can't seem to find the answer just yet, I'm questioning, why did we go straight to a 50-point cut? Why start there? And maybe what could be scaring the Fed that we currently can't see ourselves?
Whatever that may be, it certainly has kind of galvanized and solidified the Bank of Canada's current position, being down 75 basis points, and it definitely opens the door for a bit more of a comfortable cut moving forward, as opposed to, of course, the Fed staying put. Now, we want to move on to the news this week from the CMHC, and they moved the insured mortgage amount cap, like the peak, the highest amount you can get, from 1 million to 1.5 million. And it's a bit of a rant I'm going to go on, but stick with me because I think it's pretty important that we dissect this properly and share our opinions on it. The previous adjustment that they had done, it took place like 12 years ago, back in 2012. And what's kind of the most fascinating about this move is the announcement that came out of Ottawa this week regarding the insured mortgages. It really came out of left field. Like, there was no preliminary hints that they were planning this. And it wasn't really the move that, home buyers were asking for, or even the banks were pushing for. Members of Parliament that were contacted by the news portal or media portal, betterdwelling.com, well, they've also been trying to determine who knew this policy was coming. But so far, they have not been able to find anyone who was aware prior to the announcement. I think even the big 6 banks in Canada were caught off guard. Historically, they had been floating the idea of increasing that cap to 1.25 million. But 1.5, it really came as a surprise to the entire industry. So why? Why did the government make this change, and who does it actually benefit? Right? You got to ask this, because while most realtors and mortgage brokers were championing this change on Instagram and TikTok all week, you have to look a little bit deeper. Now, my position, personally, I think the improvement they've made by extending the amortization from 25 years to 30 years for insured loans is ultimately a good idea, or at least to give them the choice or the option, if you will. But that 50% increase in the mortgage cap amount, well, that needs to be examined further. I mean, what was the 1 million cap on insured mortgages really the reason that people couldn't afford to buy homes in Canada? I mean, of course not, right? Who was saying, I'm going to wait until I can buy 1.4 instead of the $1 million home I can buy today? It's just not a conversation we have as agents. If the optics of the cap increase is to help make homes more affordable, well, let's break down the numbers. For example, a first-time home buyer in Toronto, let's say, or even basically Vancouver, these numbers are almost identical, and they want to go out and they want to buy that $1.5 million starter home. Well, first off, they get to pay $45,000 in land transfer tax. That's after the first-time home buyer rebate. Okay, and that's a cash payment that they have to pay too. That doesn't get added to your mortgage. They get to pay $70,000 in these CMHC fees to insure that mortgage. And yes, that is included to your mortgage and amortized over the length of that loan, as well as another $1 million in interest payments to go to that full 30 years. So that's almost $1.2 million from the home buyer that is now going to the banks and going to the government. Are you starting to see who really benefits from this change? Now, moving on here, these changes were so unexpected and so significant that it almost begs the question, like, what are we not being told here? Almost like what Ryan alluded to with the larger rate cut. So first off, to kind of get some context here, let's discuss what actually changed. Okay, so insured mortgages will now see a maximum of 1.5 million purchase price, a 50% increase up from $1 million before. All insured mortgages will have a maximum of 30-year amortization potential as well. That's up from, of course, 25 years before. Now, like most housing policies we've seen recently from the government, they kind of share the initial idea and then even enact it, and then the details start to come to light after the fact. And apparently this policy is no different, because on Monday, the press release about this change from the government noted, quote, all buyers of new/pre-construction homes will now be eligible for mortgage insurance coverage. All, which, to most people means anybody, including investors. In fact, the Globe and Mail picked up on this and released an article mentioning how investors would now qualify for these new construction purchases under the new rules. Well, that obviously caused a bit of a flurry, and by late Tuesday, the Department of Finance issued what they call a backgrounder, clarifying or backpedaling on some of these key points. Specifically, oh yeah, wait guys, mortgage insurance is only available for homes where borrowers occupy one of the units on the property. It's a bit more clear, even if that isn't exactly right either. Because even today, you can technically buy an investment property with 20% down or more and still have it as an insured mortgage. So they should kind of get more clarification there. Maybe they'll correct that part later on too. But to kind of muddy the waters even further, my colleague over at BMO called his contact at CMHC yesterday to confirm exactly that point, right? Like, are we sure that it doesn't, or that investors can't buy investment properties with less than 20% down? And he was told that essentially there are talks, maybe we'll just call them rumors at this point, about including investors into the potential of buying insured mortgages with less than 20% down to buy a new construction property. So nothing confirmed, no percent decided so far on like the amount of down payment that would be required, but there are talks. So we'll keep an eye on that for you. Should this come to be, it would definitely help absorb some of the newly completed condo inventory that Toronto is experiencing, for example. There are a ton of freshly completed homes that no one are living in, no one's renting out, and they are for sale. That type of inventory could be absorbed by investors who are allowed to, let's say, put 5% down. Either way, the new changes that are certain come into effect starting December 15th of this year. And let's break it down further. When it comes to affordability, extending an amortization period from 25 to 30 years does in fact lower the payment on your monthly mortgage, okay, to the tune of about 9%. As monthly payments are one of the leading factors when it comes to affordability when people are buying homes, yes, that does help. 9% is a notable mark that moves the needle. But of course, yes, in the long run, it does cost the buyer more, right? The longer the amortization, the more interest you're paying. For example, on a loan of this amount, you would have a $340,000 interest over a 25-year loan. Sorry, this is on a $500,000 mortgage. You would have $340,000 in interest paid over 25 years. Extending that to 30 years, an extra 5 years, it goes up to $420,000. Okay, that's an $80,000 increase in interest payments for the benefit of paying 9% lower monthly payments. So it does sting overall. But again, if that makes the difference for somebody getting into the housing market as opposed to maybe just continuing to rent for the next 30 years, that might be the right choice for some. Though let's also explore the human psychology element of this, because if a buyer can now technically afford a home that's 9% more expensive, well, time and time again, we see the majority of buyers, around 90%, purchase at their absolute limit. So this leads me to believe that we've likely just seen a change that will push this price band of homes up by about 9% in the coming years. That, of course, does the opposite of creating more affordable homes. So a quick history lesson into the CMHC. The CMHC was originally created to help World War II vets buy entry-level homes. right? They were at war. They weren't out making money. So when they came back, they didn't exactly have a 20% down payment. So the CMHC was created to basically facilitate access to, quote, modest housing for those who couldn't save up the 20% down payment. That ultimately means that instead of creating a housing affordability initiative, the government has said, look, prices are high. They look to be going higher. So let's help people get access to high-priced homes. This change in buying power gives a larger amount of buyers access to purchase homes between that $1 million and that $1.5 million price band, which ultimately creates more demand for that price band, which creates more competition, which over time will push prices higher. Remember back just in May when Trudeau said, quote, housing needs to retain its value. It's a huge part of people's potential for retirement and future nest egg. Well, this initiative will certainly help housing retain its value. It is nice to see Trudeau keeping his word for once, isn't it? All right, jokes aside here, this is also kind of saying that like $1.5 million is the entry-level starter home in Canada now. Like, what? I'm sorry, what? That's an obscene number by any metric. And what's kind of worse here and how it's not been thought out is, unlike the US, Canada has no regional cap that reflects different house prices in different areas. So this $1.5 million cap is a blanket price that applies to the entire country. Saskatchewan, for example, has an average price home of $320K. Imagine what some first-time home buyer could have access to now. I mean, even in Toronto and Vancouver, the average home price here is $1.2 million. And so the cap is at, 25% above the average home price. A little bit interesting there. Okay. Now, that's great. So let's talk about viability now, okay? Stick with me. I'm almost through this. Let's talk about the viability of this new program. How many people will even have the ability to utilize this change and or, qualify for a mortgage under these CMHC rules? Well, let's look into it. The minimum down payment on an insured mortgage in Canada is 5% on the first $500,000 purchase price, and then 10% on any portion above that. So for a $1.5 million home purchase, it would require a minimum down payment of $125,000. Okay, that leaves a mortgage of $1.375 million. The best insured mortgage rate today, it's around 4.1%. On a 30-year amortization mortgage, that leaves that first-time home buyer a monthly payment after tax dollars of $6,600 per month. To qualify for that size mortgage and that monthly payment under the stress test, that would require a pre-tax household income of about $300,000 per year. How many people in Canada are making that type of money? Well, I'll tell you, it's 2%. 2% of earners across the country are making $300K or more right now. Now, yes, that's a single person, right? So, okay, let's say two people buy together. A couple say we're buying our first home together. It's 1.5 million. We get these great new rules and sandbox to play in. So they're averaging 135K each. Well, how many people does that apply to? About 15% of the population of Canada right now who are employed are making 135K or more. In other words, don't expect there to be a massive uptake in or at that sort of $1.5 million limit. But, there is a good chance we will see an uptick in activity, just over between 1 and 1.5. And keep in mind, this program that CMHC has created, or has extended rather, it does allow for co-signers. So parents can come in and help their children with this qualifying. And a few further thoughts on the potential uptake on this initiative. Well, insured mortgages, they exist today, right? And homes can be purchased up to $1 million with less than 20% down payment. So how is that going, right? It's been around for decades here. Well, insured mortgages on banks' balance sheets are lower today than they were a decade ago. Okay, they're becoming less and less common. Over the past decade, in fact, we've seen some of the highest appreciation rates on homes on record, especially, of course, during that COVID era. All of this was achieved without any growth in that insured mortgage marketplace. So ultimately, the existing insured mortgage buyers, they're not really moving the needle on pricing, right? There's a lot of other factors here. So does that increase to 1.5 really change anything? Well, one thing it looks to do is increase the amount of potential mortgage fraud in the marketplace. Mortgage fraud is considered to be quite rampant across Canada already. Check out this number. Equifax Canada claims they've seen a surge recently with monthly mortgage fraud flags hitting 15,000 to 24,000 mortgage applications per month. Massive number. It's almost 100 a day. Sorry, 1,000 a day almost they're receiving. Largely because there is no direct income verification provided from the CRA to the banks, which is completely ridiculous when you think about it. I mean, CRA income verification would be relatively easy to implement and could help curb mortgage fraud almost overnight. And yet it still does not exist in our country. So increasing the leverage amount to 100 or 1.5 million increases the risk and fraud amount to the banks. If you're the type of person or you're of the mind to commit fraud, going from 1 million to 1.5 is only going to really make your house nicer. So again, with no one in the industry advocating for this $1.5 million increase, why did it really come to be? Well, there's an analyst named Ben Rabideau who has a theory, and it's actually quite good and often or very plausible. And I'm just going to quote here verbatim. If portfolio insurance is also subject to these new rules, and at this point, there's every reason to think that that's the case, banks will soon be able to purchase insurance on pools of previously uninsured mortgages with purchase prices up to $1.5 million. How convenient that this change would come just as the reported arrears in the GTA and Vancouver areas, obviously the two most expensive markets in the country, are starting to rise much more materially, than the Canadian average. Okay, so what he's saying here is all of a sudden, Vancouver and Toronto are seeing a spike in arrears rates, and now they can go back and kind of insure those mortgages on which the arrears are taking place. I mean, let's look nationally here. Banks in Canada have approximately $2.2 trillion in mortgage debt. That's a big number, okay? And the ability to insure an increased amount of that debt protects the banks to a much higher degree. With the unemployment rate rapidly increasing and business insolvencies skyrocketing, could there have been some closed-door conversations between the banks and the CMHC? Maybe we'll leave the conspiracies out of this podcast, but, it does beg the question. Clearly, nothing about this increase was done to help bring the price of homes down. It simply gives more buyers the ability to buy more expensive homes and increase the ability for investors to potentially build their portfolios if they add in that segment of the buyer pool as well. So ultimately, it'll help a handful of first-time home buyers get into the $1 million to $1.5 million market. But I think pretty clearly here, the real winners are the banks. And of course, let's be honest, the realtors, the mortgage brokers, the inspectors, and those involved in real estate transactions. To me, this just speaks to, long live high-priced homes in Canada. Ryan, what's your thoughts on my long rant?
It's a lot to unpack, though I largely agree with you. I mean, nobody sent me a questionnaire about whether or not I felt raising the insured levels of mortgages was going to help reduce the overall affordability problem that we have. I mean, you mentioned that, you need about $300,000 of income in order to make this work. Well, are we expecting that kind of increase to the average salary in Canada? I highly doubt it, because that would make things more affordable. Affordability, in my mind, is actually a reduction in cost, not the ease at which to pay more. That's, in my mind, that's political math. That's saying, hey, listen, we'll make it easier in the short run so we can collect your vote, but in the long run, just don't pay attention to that. Even though, it's like, Dan, have you ever bought a car and pulled out your car payments for 84 months and looked at what the price of your car would actually be 84 months from now, as opposed to maybe biting the bullet a little harder up front and realizing that you're going to pay a whole lot less for the very same thing? This is basic math. And if you let this just pull the wool over your eyes, you will end up, again, in my mind, this just kicks the can further down the road, and we're going to have a much bigger problem, 5 years from now. Why aren't we looking at things like down in the States? What's the one thing the US has in its housing market over every other nation? 30-year mortgage terms. You want to make things affordable for people? The banks should let their consumers get a mortgage, lock it in at 1.5% for 30 years. Now we're talking affordability. But instead, we continue with this 3, 4, 5-year term segments where we got to renew all the time so the banks can always make their money. It's not helping with affordability. All it does is reduce the short squeeze and make a much bigger long-term one. So anyhow, we could go on all day about this, but it's clear again that the government is making policy decisions as a knee-jerk reaction without consulting with industry. Because if they had consulted with industry, there would be a whole slew of other recommendations that should have been looked at first. Anyhow, let's get on to housing starts. Or I don't even know why we should, because with news like this, what's the point of supply and demand fundamentals? Does it really matter anymore? But housing, if we look at housing starts, I bet you the other thing that will keep housing prices high is the lack of any available homes. So Canadian housing starts fell 22% in August. The starts were down 12% from the same month last year. This was largely due to a 55% year-over-year decline in the condo segment, registering the lowest tally in nearly 5 years. Toronto condo starts were down a whopping 70%, and I expect this to continue. In BC, starts fell 30% from last month in all areas of the province. In areas of the province with 10,000 residents or more, multifamily starts fell by 35% compared to July, and starts in the province were 30% below August levels in 2023. Year-to-date starts are down 20% in Vancouver, and completions are now outpacing new housing starts. Now, we have 2% fewer homes under construction than we did 6 months ago. You have to go all the way back to 2015 to find the last time the 6-month trend has gone negative to this extent. This metric is not going to turn around anytime soon based on the illiquid nature of home buying and the considerable lead time required to generate new supply. So much for Trudeau's plan to build 3.9 million homes by 2031. That actually would have made things more affordable. It was never going to happen because the government can't make that happen, not without help from the private sector. You need private sector partners, developers who are going to do the job for you. It's a marriage, but this just puts salt on the wounds of their overstretched promises, like we've seen time and time again.
Okay, let's move into the arrears rate now, because this is something we've been reporting on every month as the data comes out. And this week we just got the June data. And for those expecting a spike in this metric, afraid you've been let down once again. The arrears rate actually did not change month over month from May going into June. It is stuck right now at 0.19%, and that's still below, remember, that pre-pandemic arrears rate of 0.25%. Both Ontario and BC, the most expensive housing markets in our country, they did not see a change month over month either. But there are definitely cracks in the system, and I want to get into that now and give you a little bit of what might be coming in the near future here. RBC, one of the banks that submits, of course, the arrears data to the Canadian Bankers Association and the biggest bank and biggest lender in Canada, reported that their mortgage arrears rate hit 0.24% in Q3 of 2024. Okay, this data is 3 months more recent than the most current cumulative data mentioned earlier. 0.25% is more than double the rate it was just 2 years ago, and the highest going back to 2017 here. The level is less concerning than is the velocity, since fast-moving rates like that leave less time to adjust or get ready to, get ahead of it, if you will. So that thing, for those on YouTube, we'll share the chart, but it is increasing rapidly. And it gets a little bit worse here if we look to just the Greater Toronto Area specifically, where RBC reported that rate had climbed to 0.27% in Q3, surging 6 times over that same period. These are almost certainly to be predominantly from those condo investor mortgages, right? Much less so than end users. Are the other banks out there experiencing a similar increase? We'll find out soon enough as the data is updated every month here, but we'll continue to update you on that as well. But with Canada's largest bank being RBC seeing that level of increase, I think we can expect others to be in a similar boat. So while that metric is still in a very comfortable position, let's say today, as far as the June data goes, I think we're going to definitely start to see an uptick throughout the rest of 2024.
Yeah, moving over now into consumer insolvencies. Consumer insolvencies rose by 24% year over year in Canada, led by a 28% increase in bankruptcy filings. Insolvencies hit 135,000 in July, still below the pre-pandemic level of 140,000, but it's getting up there and it's rising quickly. Ontario is feeling it the most, though. Their consumer insolvencies hit a 12-year high in July. And businesses in that province saw insolvencies up 45% year over year, and they were nationally 31%. This is Canada's largest job market. And if it's suffering like this, chances are we're going to see more movement out of the central banks to ease the friction when it comes to borrowing money. Much like I kind of indicated earlier, small cap businesses are the ones that need this more than anything. So we need it faster than it's coming. Canada debt service ratio rose 15% in Q2, in line with the all-time high seen in 2007 and 2019. This ratio is 50% higher than the US, with household GDP ratio also sitting 25% higher. The mortgage debt service ratio is at an all-time high, reaching 8.2% of disposable income. And if you bought a house in the last couple of years, it is way higher than that. But this will go higher as mortgage renewals in 2025 and 2026 continue to take place.
So you hear all this news and it seems like, there's no doubt this thing has to continue to crack and start to fall apart and break, if you will. Okay, yeah, warranted, right? These are really terrifying numbers and they seem to be increasing velocity. But let's be fair and let's look at the other end of the spectrum, okay? And that today, the reference is going to be household net worth. And essentially, which also speaks to the economic divide that is taking place in our country. Because despite the economic turndown, lowering real estate prices, spiking insolvencies, Canadian household net worth actually just hit a new all-time high in Q2 of this year. It rose 0.2% quarter over quarter to hit $17 trillion nationally. This was largely on the back of a strong quarter from the TSX and US markets, pushing assets up almost a full percentage just last month alone. Are you ready for this? Here's the number. The average Canadian now has a net worth over $1 million. The average Canadian. That sounds extremely high to me, but this is what has been reported from StatsCan. And that's up 2.5% year over year. And the reason we're sharing this is an important metric, is rising net worth households are far less prone to defaulting on debts during hard times. Why? Well, quite simply, they have assets they can sell. So even despite all these rising debt stats that we've just shared, Canadians still own $6.64 in assets for every $1 of debt that they're carrying. This ratio looks to improve in the near future as well, because Canada's savings rate just broke 7%. I mean, outside of that free money era of the pandemic, which just doesn't count, you have to go all the way back to 1996 to see Canadians saving this much money. So it's a very interesting dichotomy, seeing one chunk of the world, if you will, or the nation kind of falling apart in all these horrific headlines. And then you've got this other half or other segment that are literally worth more and saving more than they have in 30 years. It's fascinating to watch.
Yeah, Dan, it's because they're not buying any houses right now. With that being said, though, I also think it speaks largely to the wealth gap, the wealth divide. If you don't have assets, if you don't have an investment, and whether that's a house or whether that's a stock or you own a company or dividends or something to that effect, you are going to be left behind, especially when inflation gets back to a normalized level. Please have an investment. Anchor, don't just hold cash. Cash will continue to devalue over time. It needs to be put into an asset. That's why Canadians are feeling wealthier than ever. And typically in this time, it's because money is moving from weak hands to strong hands, and it'll continue to do that. Let's have a look at DCCs. This is development cost charges, as they are potentially ruining the landscape for new home supply. We've been discussing the impact of increasing city charges on new developments for some time on this channel, and another example of this surfaced this week, outlining the increases from 2010 until now, and especially from 2020 until today. These numbers are for single-family homes in the Greater Toronto Area, but are representative of what we're seeing in Vancouver as well. I won't break it down by region per se here, but the numbers to pay attention to: a 68% increase in development cost charges from 2020 until today. For those of you on YouTube, you can see this increase in the provided chart. Some areas have seen as much as 138% increase in just the last 5 years, and understandably, developers in Vancouver are hugely frustrated with the rate of these increases, and some have banded together to try and push back. Developers including West Group, Polygon, Anthem, Strand, and Edgar are pushing the Metro Vancouver Regional District to reconsider these DCC fee increases. Earlier this week, Bo Jarvis, president of West Group Properties, developers of the well-known River District and the upcoming Civic District in Surrey, reignited the conversation by sending letters to the MVRD Board of Directors. This letter was also emailed to city councillors across the region, as well as federal ministers Sean Fraser, Ravi Kahlon, and BC Premier David Eby, alongside a group of reporters. And his letter states, and this is verbatim: housing starts in Metro Vancouver have plummeted, dropping by 20% year over year in the first half of 2024, and that's according to CMHC. In addition, many multifamily projects are not moving ahead. Pre-sales for projects in the first half of 2024 are 29% below the average of the past 10 years, and of the 8,593 units released, only 1/3 have been pre-sold, signaling that many of these projects just simply won't move ahead, as they may not hit the financing test to meet requirements of the Real Estate Development Marketing Act. It goes on to say, to illustrate this point, in the city of Vancouver, there are 14,600 units which have an approved rezoning or development permit that have not started construction. In Surrey, there are 34,000 units approved but not yet built. The viability of these projects is questionable, given the Vancouver Metro DCC increases were not known at the time of the application. You got to think, if you're putting an application together and you're basing it on the numbers that you currently know, and then those get changed midway through your application to make your project unfeasible, you'd have something to say about it. There are also 48 projects in court-ordered sale, foreclosure, or receivership in Metro Vancouver. An additional 10 projects are notably not moving forward, which means over 10,000 proposed housing units in Metro Vancouver are not proceeding due to viability issues. Jarvis goes on to offer recommendations on how to make DCCs viable for developers, and concludes his letter with requests to speak to the Metro Vancouver board meeting on Friday, September 27th, and then again at a later Finance Committee meeting. Ideally, systemic changes would come from this as an alternative to being continued chronic underbuilding, seesawing effect based on interest rates and based on DCCs. Unaffordability, it appears, is at every turn, and arguably for everyone. And it's my bet that development fees and property taxes will become the next contentious issue for local residents as governments continue to put the squeeze on their local residents. It's effectively who it impacts at the end of the day. Developers will pass on these costs. They're not going to take them. And if they don't, they're going to move on to a different market and none of us here are going to get the homes we desire. Imagine if everyone, just for a second, imagine if everybody just took their hands off the levers for a couple years and just let simple competition help play out here.
Seems like a dream at this point. But what I find really fascinating about that article is, I mean, we're talking about 60,000 homes are essentially at risk because of rising fees. And yes, of course, there's many elements that go into the cost of building a home, but DCCs and the rate at their increase is definitely affecting a lot of projects. I'll remind everyone, I spoke with a developer a couple months back, and they said literally one of the biggest risks to their pro formas is the unknown amount of city fees that may be created between now and their project's completion that they're going to have to pay. So imagine if 60,000 homes hit the market this year. That would certainly change, well, pricing, if nothing else. And well, let's wrap up today's episode. Thanks so much for making it this far with a mid-market update, right? We talked about September was kind of going to be, the make or break probably change in the market here, right? Was it the TSN turning point for the marketplace? It is not. No. In fact, at this point, I would say there's going to be no fall market. And by that, I mean overall activity levels perk up. So here we go. We're recording this on September the 19th. We've got almost 3 weeks of data in for the month. And let's break it down for you because it's interesting as always. New listings, we're at like 4,600 new listings, on pace for about 7,000 new listings for the month. That would be the highest we've seen since April. And if it even goes over 7,100 new listings, it would be the highest for any month dating back to 2021. Okay, at least a 3-year high new listings. But here is the interesting part. Inventory is still only sitting at like 15,700. So that's a number that we've seen for basically 3 months now. I mean, there was more active listings at this time in July than there is today. And typically September, we see that spike on top of active inventory, but it looks like, at the end of the month, we're going to wash out very close to where the total inventory was back in July. Going back 5 years, only 2020 saw a September with more inventory than the month of July. So it's not even that uncommon, at least in the last 4 or 5 year cycles. So while there is a spike in new listings, there's no significant increase in inventory. Apparently, lots of listings are coming off the market because I'll tell you, they certainly aren't selling. When we look at sales, we're only at 1,150 units sold this month. We're on pace for about 1,900. That will barely beat August, what is typically a very slow month, and is almost identical to where we were in 2023, another slow month back then. And lastly, what is going on with price? Interestingly, average home prices right now, they're almost exactly where they were a month ago, but median is down another 20K. Median prices are now sitting at 925,000, hitting a 1-year low, and also about 7.5% off of the all-time peak seen 2 years ago, 2.5 years ago now. So that's what's happening. Thank you so much for tuning in this week. There was a lot happening, lots of moving pieces here, and a lot that are going to affect the Vancouver real estate market. Thank you as always for tuning in, watching. We will keep you updated on what's important in Vancouver real estate next week. See you then.